Hello and welcome to video 2 of lesson number 1, in which I discuss secondary drivers of the gold price. The yield curve. The yield curve or yield spread is the difference between short-term yields and long-term yields and is also a driver of the price of gold. The most common spread is the difference between the 2-year yield, which is a proxy for the Fed funds rate, and the 10-year yield. A flattening curve, which entails a shrinking or decreasing difference between the two yields, usually accompanies the broad middle part of an economic expansion and stock market boom. The yield curve flattens because the Federal Reserve is raising short-term rates and they are rising faster than long-term yields. The result is disinflation, a decrease in the inflation rate, which is bearish for gold. On the other hand, a steepening curve or widening of the yield spread is bullish for gold. This can happen in one of two ways. Long-term bond yields rise faster than short-term rates, implying an increase in inflation expectations, or short-term rates decrease faster than long-term yields. That implies risk aversion and a loss of confidence in the economy and capital markets. The yield curve will move from flattening or inversion, short-term rates are higher than long-term rates, like we see right now, to steepening when the Federal Reserve starts cutting interest rates. We plot gold and the yield curve, 10-year yield and the 2-year yield, the difference between the two, in figure 1.3. We highlighted in yellow periods in which gold performed well and the yield curve was steepening. As you can see, the flattening curve in the late 1990s and from 2014 to 2018 coincided with gold's decline and lack of performance. The flattening curve since early 2021 also coincided with a stagnant gold market. On the other side, the steepening of the curve into 2001 coincided with the major bottom in gold. The steepening continued after the depths of the financial crisis, and gold continued to rise alongside that steepening. The steepening of the curve in 2007 preceded gold's surge above $700 an ounce, up to $1,000 an ounce. At present, the yield curve has inverted again. The economy is likely already in recession, and the market is anticipating the Federal Reserve will cut interest rates in early 2023. The yield curve will begin to steepen when the Federal Reserve cuts interest rates, which we anticipate could be before 2023. That is very bullish for gold. The US dollar. The US dollar trend is an important factor in determining the trend of the gold price because gold is priced in US dollars. More importantly, gold is essentially an alternative to the US dollar because it is the global reserve currency. While gold is negatively correlated with real interest rates, the US dollar tends to be positively correlated with real interest rates. However, it is important to note that the negative correlation between the two is not perfect, and there is some evidence that the correlation has lessened recently. In figure 1.4, we plot gold and the US dollar index. The thick vertical lines mark important turning points between the two, while the thin vertical lines mark less important turning points. We have several important observations in the history of gold and the US dollar. First, gold cannot be in a sustained secular bull market if the US dollar is rising. There are certain periods when the two can trend together, and the 2016 to 2020 period, and specifically August 2018 to August 2020 period, show that gold can perform well even if the US dollar is relatively stable and not plunging. Ultimately, a secular bull market in gold requires a relatively weak dollar over a long period. Second, The negative correlation between gold and the US dollar is less than normal on a longer term basis. For example, the dollar's all-time high was in 1985, but gold's post-1980 low did not occur until 1999. The dollar's all-time low was in 2008, but the gold price is much higher today than in 2008. The dollar in early July 2022 is higher than at the very end of December 2016, while the gold price over that period is nearly 50% higher. Here are a few other examples. The dollar's worst decline was from 1985 through 1987, but gold experienced only a modest cyclical bull market then. In the 1970s, the dollar's decline was modest, but gold's run during that period was historic. Third, gold has performed much better during the current long-term uptrend in the dollar than previous uptrends. The uptrend in the dollar from 1980 to 1985 and from 1995 to 2001 coincided with some of the worst declines in gold. The dollar has gained almost 40% in the last 9 years, yet gold is still up some $400 an ounce during that period. Finally, in studying the recent history between the two currencies, I have noticed the tendency for gold to lead the US dollar at key turning points. In other words, gold can bottom before peaks in the US dollar, and gold can also peak before bottoms in the US dollar. There are numerous examples. During its historic bottom in 2001, gold bottomed more than several months before the US dollar peaked. In the second half of 2005, gold began a significant move higher, yet the US dollar rose during the early portion of gold's move. After correcting over 30% during the financial crisis, gold bottomed in October 2008, yet the US dollar would not peak until several months later. Gold bottomed in August 2018 and would rise roughly 80% over the next 2 years. The US dollar did not peak until March of 2020. It trended alongside gold for most of 2019. This leadership also works in reverse. Gold peaked in the summer of 2016. The US dollar declined below its 2016 low in 2017. It made a new low, yet gold could not surpass its 2016 high. Also, gold peaked in August of 2020, but the US dollar did not bottom until January 2021. At present, gold is succumbing to US dollar strength. The surge in the dollar since April 2022 has caused the gold price to drop below $2,000 an ounce to $1,700 an ounce. Judging from history, we should look for the gold price to bottom before the dollar peaks. The significance of the coming dollar peak will tell us if gold can rise for only a few years or if it can begin a new secular bull market. One way to analyze gold's performance in real terms is by charting gold against foreign currencies, or the inverse of the US dollar index. A simple way to calculate this is to multiply gold by the US dollar index. In figure 1.5, we plot gold along with gold against foreign currencies, which is in blue. There are a handful of examples over the past few decades of gold against foreign currencies leading the gold price at key turning points. In the early 2000s, gold against foreign currencies made a new 52-week high in the spring of 2001, just as gold emerged from its double bottom. Several years later, in the middle of 2005, gold against foreign currencies made a major breakout to the upside. Gold followed several months later. Gold against foreign currencies provided another important divergence during the financial crisis. It bottomed a few months before gold bottomed in late October 2008. Gold against foreign currencies broke out to a new high in early 2009, months before gold did. Finally, gold against foreign currencies recently broke to a new all-time high in August of 2019, a year before gold did. There are also examples of gold against foreign currencies lagging the gold price and not confirming its strength. Note the red arrows in the mid-1980s and the mid-1990s. Gold made higher highs during these periods, yet gold against foreign currencies did not. In 2017 and into 2018, the gold price was making higher highs, but the gold against foreign currencies did not confirm that. Non-confirmations from gold against foreign currencies can lead to declines in the gold price. Gold against foreign currencies reflects how gold is performing without the effect of the US dollar. If gold is rising, but gold against foreign currencies is weak, then it is a sign of a weak US dollar and not strength in gold. If the dollar is climbing, but gold against foreign currencies shows strength, it's a signal of the strength in the dollar more so than weakness in gold. The US dollar has risen gradually over the last 11 years, but gold has held up far better than it did during the other periods of US dollar appreciation, being 1979 to 1985 and 1995 to 2001. The reason is that gold against foreign currencies has been consistently stronger than in the 1980s and 1990s. From August 15, 2018 to August 6, 2020, gold gained 75%. During the same period, the US dollar declined by only 4%. If and when the US dollar declines materially over an 18 to 24 month period, then gold, given its ongoing strength against foreign currencies, has the potential to skyrocket during that period. Thank you, and I look forward to the next video in which I discuss and analyze why supply and demand does not affect the gold price.